Welcome to today's Explainer. We're jumping right into a fascinating and honestly pretty overlooked layer of the tax code that aggressively targets private wealth. Look, if you've got a growing investment portfolio, real estate, or you own a business, you might actually be triggering a massive hidden tax without even realizing it.
So ask yourself, are you secretly paying a 3.8% surcharge on your success? Because that is the reality of the net investment income tax, or NIIT. For so many high net worth investors and business owners, this stealthy burden catches them completely off guard, just quietly eating away at their after-tax returns.
Okay, let's dive into this. 3.8%. That is the magic number for this explainer. Now, this was introduced back in 2013 as part of the Affordable Care Act to help fund Medicare. It's technically called the Unearned Income Medicare Contribution Surtax. But honestly, the impact is what we really care about here. It's a 3.8% tax that hits specific investment income for individuals, estates, and trusts the second they earn above certain statutory thresholds.
Here is our roadmap. First, the stealth wealth tax. Second, triggering the thresholds. Third, active versus passive income. Fourth, real estate and business. And finally, strategies to protect wealth.
Part 1. The stealth wealth tax. So why do we call it a stealth tax? Well, it's because NIIT doesn't replace your existing taxes. It literally just stacks right on top of them. Think about it like a layer cake you didn't order. You might think you're paying a standard 15% long-term capital gains tax on a stock sale, right? But if the NIIT applies to you, that 3.8% is quietly layered on top. Suddenly, your 15% rate is an 18.8% rate. It turns a totally reasonable tax rate into a significantly higher one without you changing a thing.
Let's move to Part 2, triggering the thresholds.
This tax doesn't apply to everyone. It only kicks in when the math dictates it. And there are two main pillars here. The first is your modified adjusted gross income, or MAGI. Now, for most of us living and working in the US, your MAGI is basically going to be identical to your regular adjusted gross income. It's essentially your AGI with just a few rare deductions or foreign earned income exclusions added back in.
And the math on this is incredibly rigid. If you're married filing jointly, the NIIT threshold is $250,000. Single filers, it's $200,000. Once your MAGI crosses those strict lines, boom, your investment income is vulnerable. And here's an absolutely crucial detail. The IRS does not index these statutory thresholds for inflation. No way. So as incomes naturally rise over time, more and more taxpayers are just stumbling right over these lines and getting caught in the NIIT net.
The second pillar is the net investment income itself. Notice the word net there. You aren't necessarily taxed on the entire gross amount. You get to subtract allowable investment expenses from your investment income. We're talking things like investment advisory fees, brokerage fees, or certain rental expenses. Those can all be deducted to cushion the final blow.
Now here is where the IRS math gets really fascinating. The tax isn't just a flat 3.8% applied to all your investments. It's essentially a lesser of two evils calculation. Step 1. You calculate your net investment income. Step 2. You calculate exactly how much your MAGI exceeds your specific filing threshold. And then Step 3. You only pay the 3.8% tax on whichever of those two numbers is smaller.
To really wrap our heads around this, let's look at the Luna versus Lucky case study from the source material. Both of them are single filers and both made a total of $460,000. Great year for both. But Luna made $220,000 in wages and $240,000 in capital gains. Her NIIT liability comes out to $9,120. Lucky made the exact same total but flipped the income sources, $240,000 in wages and $220,000 in capital gains. His liability dropped to $8,360. Because the tax targets the lesser amount, having slightly higher wage income and slightly lower capital gains literally saved him money. Structure is absolutely everything here.
Which brings us to Part 3, active versus passive income.
And this brilliantly illustrates a stark contrast in how the IRS views where your money comes from. If you're a passive investor, meaning you don't materially participate in a business, that income is squarely in the crosshairs of the NIIT. But if you are a material participant, which generally means you're working over 500 hours a year in the business and actively managing things, that operating income is entirely exempt. That is a massive financial advantage.
Let's do a rapid-fire checklist of what's actually subject to this tax. We've got capital gains from stocks, bonds, and mutual funds, dividends and interest, most rental property income, passive business income, as we just saw, and, yep, even distributions from non-qualified annuities. You really have to be careful here, because something as simple as the capital gain from selling a second home can trigger this surtax. But thankfully, there are some solid safe havens. This is income completely exempt from the NIIT, your standard wages and self-employment income, active business operating income, interest from tax-exempt municipal bonds, Social Security and alimony. And this is huge for your retirement planners. Distributions from qualified plans like a 401k, traditional IRA, or 403b. Those completely sidestep the 3.8% surcharge.
Moving on to Part 4, Real Estate and Business.
Now, what's really interesting here is a specific concession the IRS made regarding rental income. Ordinarily, rental income is passive, right? So it gets hit with the NIIT. But take the Farmer Bean case study. If Farmer Bean personally owns land and rents that exact land back to his own farming business, a business he materially participates in, that's known as a self-rental. The IRS actually concedes that self-rentals, or properly grouped rentals tied to your active business, are shielded from the NIIT. They get reclassified as non-passive.
And for business owners looking to sell their S-corporation, calculating what exact portion of that sale is subject to NIIT can be a total nightmare. But there is a fantastic shortcut highlighted by Eisner-Amper, known as the 5 and 5 rule. If your net investment income was 5% or less of your total allocated income during the holding period, and your gain on the sale is under $5 million, or if your total recognized gain is just $250,000 or less across the board, you are allowed to use an optional, simplified calculation method. It will save you and your CPA an unbelievable amount of time and headaches.
Finally, Part 5, Strategies to Protect Wealth.
All right, here is your defensive wealth protection checklist. Take notes. First, utilize installment sales. If you sell a business or property, spreading those gains over multiple years can keep your MAGI safely below the threshold. Second, if you're charitably inclined, donate appreciated assets directly or use qualified charitable distributions. Third, invest in municipal bonds. Remember, their interest is exempt. Fourth, maximize those contributions to qualified retirement accounts to push down your taxable income today. And fifth, practice tax loss harvesting. Intentionally sell investments at a loss to offset your capital gains.
So the crucial point here is that timing is everything. You absolutely have to manage your income timing. For example, doing a massive Roth IRA conversion might sound like a brilliant idea, but the taxable portion of that conversion artificially spikes your ordinary income for that year. So while the conversion itself isn't subject to the NIIT, it drives your MAGIs sky high. That could accidentally push all your other passive investments right over the threshold and straight into the 3.8% trap.
Which brings us to this incredibly important quote from our sources. The most important thing about NITIT is that it's often avoidable or reducible with proper planning. Waiting until tax season in April to suddenly try and address this is a losing strategy. Proactive, year-round wealth management is literally the only way to effectively shield your assets.
I want to leave you with this final, provocative thought to chew on. Take a hard look at your financial architecture today. Is your portfolio just structured for gross returns, or is it genuinely structured for after-tax efficiency? Because as we've seen, generating huge returns doesn't mean much if stealth taxes are silently draining your wealth in the background. Thanks so much for joining me on this explainer, and happy planning!